I'm going to be talking about the spread of microinsurance in India in the last only about 15 years actually. Even the phrase microinsurance didn't exist in India till about 2005, although there were some policies which could be called microinsurance a few years before that. And I have the experience of doing it on the ground as well as having been a member of the Insurance Regulatory Development Authority. So I'll speak from both the points of view. So the risks faced by the rural poor in India are no different, I think, from the risks in Africa, but I don't want to make a generalization. So I'll focus on my own experience in India. And the risks are both what I call idiosyncratic, which are specific to an individual farmer or household, such as lower crop yield or specific disease incidents or theft. And then there are covariant risks which happen to a whole community or indeed a whole region, such as drought or flood in the area or an epidemic disease. And long before insurance came, of course, people have been doing whatever they can to, to sort of manage the negative effect of adverse events. Things like storing grain, having some savings, accumulating assets, especially livestock in good years, giving loans to and taking loans from friends and relatives at no interest. All these are basically traditional mechanisms of risk management. And the take-up of insurance has been rather low, and I think that is, though poor people are called risk-averse because of that, but actually it's a rational behavior because their vulnerability to shocks is high, and their net worth is low or sometimes even been negative. And therefore the premiums that they have to pay for any kind of coverage is a significant portion of that. So it's not rational for them to take traditional forms of insurance. According to the global survey by MIC in Geneva, in 2005, India was the microinsurance champion of the world. And I think it has retained that position. Microinsurance is, of course, can be very small amounts of coverage. In India, there are policies which cover as little as $40 of sum assured, and the premium can be as low as 50 cents a month. But because there are hundreds of millions of people who could use this, according to Swiss Re and Lloyd's, the total market for microinsurance could be as large as $40 billion. And in 2012, there are already 500 million insurance policies in microinsurance, according to a study by Munich Re and ILO. And the specific story of India is quite interesting. Though using the traditional parameters of life insurance density, which is per capita investment in US dollars, India is still quite small in terms of the share of the GDP, only about 3%, but you can see that there's been an increase of 50% in that itself. And in terms of insurance penetration, again, there has been an increase. Non-life insurance coverage is not as strong. It's only about a fraction of 1% of the GDP, but it's also increasing at a fast pace. Just to give you a sense of the incremental size of the market, in the last fiscal year, 2012-13, 5 million individual lives and 13.9 million lives under group life insurance were covered under the microinsurance with a total premium of $53 million. Now, I'll come back to this slide, but we not only continue to provide the large numbers, but also at a very low cost. And to give you an example, there is this flagship program of the Ministry of Labour and Employment in India called the Rashtriya Swasthya Bima Yojana, which covers hospitalization for a family up to 30,000 rupees or $500. By the way, that's enough for significant levels of hospitalization. Of course, doesn't cover terminal illness and things like that, and doesn't cover things like, say, a heart condition. But most other injuries and so on can easily be covered in this amount. And it's a family floater, so if more than one member requires it during the year, then the rest of the amount can be used for the other. There are nearly 9,000 public and private empaneled hospitals which serve these clients. The premium is as low as $7 or 16, depending on how much subsidy the state government gives. And the beneficiary hardly pays a very small amount, 67 cents. Now, to give you a size of the scale of this, and you can visit the website where the number keeps ticking every day, but on 30th April, sorry, that should have been 2014, not 2010R, it's 37 million smart cards had been issued. That's an enrollment time. And 7 million people had already used this insurance since the time it was launched about 5 years ago. There was a GIZ evaluation which showed that 94% of the intended beneficiaries were aware. 90% traveled less than 2 kilometers to get the smart card. And those who did not have any coverage spent $283. So you can compare that to the average per capita income of India, which is now just about getting to $1,000. So that's a lot of savings. Crop insurance again is very important for farmers. We just heard from Mara. And India has been providing the traditional yield-based crop insurance, which is not very satisfactory either to the farmers or to the insurance companies or to the government. So everybody is dissatisfied. And that has now, in the last 10 years, been steadily being replaced by other methods, particularly weather index-based crop insurance. And I'm proud to say that my organization, Basics, is a global pioneer in that. We made the first weather insurance contract in the world jointly with the World Bank's risk department in 2002-03. And since then, that idea has spread to over 2 million farmers in India. The traditional crop insurance still covers 10 times as many. So the thing about weather-based insurance is that the basis of claims is much more transparent and known to the farmers, and sometimes, in fact, it is nearly instantaneous. There are some crops, such as groundnut, where actually, because of the sowing window being quite long as 90 days, it's possible that if there's germination failure, that you get the insurance payout and you can use the money to sow a second time. And for that reason, it's very popular with farmers, compared to the old crop insurance where the crop cutting would take a whole year, and by the time the results would come and the payout would happen, it would be 2 years, and it would just be debited to your account in the bank. So very quickly, what were the main reasons for this huge jump? First is, of course, that the Indian economy itself took off in the last decade, although it slowed down to about 5.5% in the last 3 years. But still, it is now the world's third largest economy in purchasing power terms. A new generation regulator, the Insurance Regulatory and Development Authority, was established in 2001 under a new insurance law. And the IRDA formulated rural and social sector obligations right at the outset, making it clear to new players, even before they got the licenses, that inclusion is central to insurance in India. Once again, I'm very happy to say that we advocated for this very strongly, and it was adopted by the regulator. And as a result, I think I was invited to sit on the Insurance Regulatory Authority for 5 years. And India issued the world's first microinsurance guidelines in 2005. They're available on the IRDA.gov.in website. The use of distribution channels for microinsurance is very important, appropriate ones. And microfinance as well as self-help groups, which is a kind of community-based microfinance, both of them reaching together about 100 million households, are the two natural channels through which microinsurance is done. And the last point is, of course, that the government has been both subsidizing, particularly crop insurance, and also permitting cross subsidies, as for example in third-party motor insurance. There are still many areas which need improvement, though. The first is what I call pre-insurance risk mitigation for health, crop, and livestock. Many of these areas of peril are such that the actuarial risk for poor households is so high that the premiums would have to be 12, 14, 15% for it to be remunerative for the insurance company, assuming that they'll take about 1 to 1.5% for the administrative costs and profits. So, unless the actuarial risks are reduced, there is no point insuring these risks because nobody is going to be affording them. And to try and subsidize insurance premium is the wrong end of the subsidy. Instead, the government, the public investment should go into mitigating these risks. For example, in case of health, the main reasons for disease in India are waterborne diseases and respiratory diseases. These are the two main ones in rural India. So if safe drinking water is provided, sanitation facilities are provided, and vaccination is universalized, immunization is universalized, if cooking stoves are made more popular and housing designs are changed in such a way that there's ventilation, then the disease incidence will come down so much that the insurance premiums will automatically come down. And so it would be more appropriate to invest in public health investments first rather than in subsidizing premiums. So that's one debate that has not been fully resolved, because politicians always find it easy to subsidize something and make voters feel good, rather than make long-term investments in public good. The second
Vijay, you have 1 minute to
yes,
wrap up.
Thank you. In the quest of coverage, the service levels are suffering, and there are issues about consumer protection. In my 5 years in the IRDA, I worked a lot on that issue, and today the IRDA has not only a nationwide ombudsman network and a helpline in several Indian languages, but also a separate web portal for making complaints. Claims settlement, therefore, has become far more easy, and particularly for the poor who otherwise end up just paying premiums and don't get the settlement because of various documentation reasons. And I'll skip the 2 slides on basics, but I'll take just half a minute on some lessons for other developing countries. First is that it is possible to both liberalize the insurance sector and attract multinational companies. There are 29 insurance companies who came to India since 2001 and yet meet national social goals. Every one of them is compliant with the rural and social obligation policy, which was imposed right at the beginning. But the traditional microinsurance with remuneration levels of 20% premium are inadequate because the costs as a percentage of premium are much higher. Same story as microfinance. And therefore, we have to try new technologies, for example, using the network of IT kiosks to do online insurance and online claim settlement. Work is being done in India on this, but it is still. And finally, regulating prices and capital participation, particularly by foreign institutions, leads to setbacks. So liberalization means that you need to liberalize fully, but you can impose obligations, and then it will work well. Thank you very much.